Hello, and welcome to a very special edition of the Bank Tellers, where we dive into the intersection of TradFi and DeFi. A major topic we'll be discussing more at Money 2020 USA this October. Today, we are joined by Paul Brody, EY's global blockchain leader. Hey, Paul, how are you doing?
I'm good, thanks. How are you?
I'm great. Thank you so much for joining us today at what is a really interesting time to be in that intersection of DeFi and TradFi. And I know at EY, you guys sit at a very unique position. You're advising big banks, regulators, fintechs, and even governments on how blockchain and digital assets fit into the future of financial services. So I think a great place to start is, I guess, to ask you from where you're sitting, what's the state of play with blockchain and financial services today? Where are we and what are you seeing?
So we're at the beginning of what I expect to be a long game of regulatory and operational and business convergence. We are relatively few years away from a point where it's not really going to be possible to tell the difference between an on-chain financial service and an off-chain financial service. The differentiation between TradFi and DeFi is basically going to disappear. And there's an old saying, and I don't know where it came from, but organizations that oppose each other tend to eventually come to resemble each other, and that's exactly what's happening. So the banks are busy getting into crypto, and the crypto companies are busy getting banking licenses, and everyone's getting ready to launch a stablecoin. So eventually these things are going to converge to the point where it's not going to be really visible who's doing what.
I love that saying, actually. I haven't heard it before, but that's a really interesting way to put it. In terms of, touching on or starting off with at least the big established financial institutions and the big corporates, what is the state of play from what you're seeing? Has there been a lot of progress made in terms of how they're engaging with blockchain and digital assets? Are we still in that early experimentation phase, or are we seeing a much more clearer route to scaled up adoption?
We're in the dam just broke phase. So that's really what's happened. So for the last I want to say 5 years or so, prior to about, I want to say April, May of last year, basically the world's major banks were looking on the sidelines. And some of them were looking on the sidelines and saying, I want to be in this business, right? I can sell stuff in here. And some of them were looking from the sidelines and saying, wow, I hope this thing never comes for us. But either way, people were looking on the sidelines, but not doing anything. So there was a little bit of testing and studying and playing, but no substantial action. Once the ETFs got approved, and then particularly, so there was MiCA in the European Union last year that went into effect, and in the U.S. there was a Trump election, and then the long before the Genius Bill got written and signed, everybody knew it was going to happen. And that basically sort of triggered the dam breaking. And so like crypto, like stablecoins, or hate them, it doesn't matter. Everybody is now into this market because they understand that it is going to be absolutely transformational. So we are now in the stampede to enter the market, where people are suddenly going from strategy to, okay, I need to do this. I need to participate. And people are getting quite serious about this question of, well, how will I build some kind of differentiated competitive advantage in this market? And no, I don't think anybody yet has a really good answer.
It's so interesting the way you've broken down, especially when it comes to the kind of the ETFs as being one of the big kind of starting gun points for we're seeing right now. And I guess my question to you is, on the one hand, one interpretation is that there were a lot of players, especially from the established institutions, who were, keen to get involved, but were wary of the lack of regulatory or legislative clarity. Or a different way of looking at it is that they're kind of being dragged as a result of what's come, a time where we're probably borrowing a bit from that crypto world, FOMO, a lot of FOMO. So what is the real driver now? Is it more the FOMO side of it, or is it more actually there's a lot of players who've been keen to get involved, but now they feel like they've got some of that kind of regulatory and legislative approval to do so? Which is the kind of the bigger driving factor in some of the adoption and interest in the space we're seeing?
Wow, that's a really tough question, because for sure there's FOMO, right? I mean, crypto is inventing this whole new world of assets. And at the end of the day, banks and financial institutions, they make money selling stuff to customers, right? Products or loans or financial assets. So on the one hand, there is absolutely this FOMO, like, wow, there's like a billion new things we can tokenize and sell. And that's awesome. And also it's terrifying, because what blockchain technology does, especially the public open blockchains like Ethereum, what they do to some of the existing sort of process and pricing standards is really scary for large banks. One of the big transformations that's happened over the last 50, 60 years is we went from a world where banks made money loaning out money to a world where banks are transaction processing engines. They make money executing these transactions, buy, sell, trade, transfer. And a good example of the kind of compression that blockchain does to these transaction fees is international transfers. It's probably the most extreme example, but we're moving, what blockchain enables is a move from dollars and days to under a penny, under a second. That's the benchmark. So a lot of those transaction fees are under threat, and they account for a very, very large percentage of bank profits at the moment. So it's going to be both, and it is depends on sort of which side of the bank that you're sitting in that you feel the big effect.
Got you. And in terms of, to kind of dig down a bit deeper into I guess, the kind of worldview within these organizations, as you're speaking to these established banks and large financial institutions, those we might call, the TradFi world and the leaders in those institutions, what are the biggest misconceptions you're still seeing when it comes to, the impact of blockchain, both for their business, but also, in terms of how it's going to affect the financial world we've come to know so far, really?
That's a very interesting question because people have so many different sort of ideas and misconceptions about how this stuff operates. I would say, to me, one of the biggest ones is this idea that DeFi is successful or will be successful because of regulatory arbitrage. That it's just a case of going to a place where there's a lower level of regulatory coverage and it's easier. Now, there is some truth to that. And this reminds me a lot of the early days of like ride sharing, right? Ride sharing services in many cities are basically illegal, or at least they were, but people use them anyway. And they sort of reached a point where sort of switching them off wasn't possible, right? DeFi, in many respects, wasn't regulated, wasn't in a clear position, absolutely had big advantages when it comes to like low regulatory costs, less scrutiny. It's allowed to do things like bearer assets that traditional banks have not been allowed to do. So there is an element of regulatory arbitrage, but it's really, really important not to confuse regulatory arbitrage with some extremely compelling competitive value propositions. And this is the big danger, is that people look at it and just say, oh, it's less regulation, that's why it's successful. That's not the biggest driver. The biggest driver is you can take a lot of the stack of an existing financial institution, and instead of packaging up the whole thing together, you can peel off one slice of it, you can turn it into a piece of software, and you can deploy it with extreme efficiency and speed. And so if you get blinded by this idea that the DeFi players will be at the same disadvantage as you are once they face all the regulation, then you're going to make some very big strategic mistakes. So that's probably the number one misconception. I think the number two misconception is this big question of like, how does technological change happen? And it's quite rare that you have one of these moments where film cameras are suddenly replaced by phone cameras and a whole industry kind of dies overnight. Much more typically, what you get is like sedimentation. So new stuff comes with the new technology. And whether this looks like a sort of Kodak style moment with a rapid replacement or a gradual sedimenting of systems and institutions, I don't think we know the answer to how this transition will play out. But that has big implications for the likely speed, right? This assumption, it's not a good assumption on either side that somehow crypto or blockchain technology will magically wipe out the credit card industry or the traditional banking industry. That's not going to happen. But at the same time, it's also, you should not be confident that just because, say, credit cards with mileage points have successfully resisted every effort to go to debit cards and cut out fees by really powerful retailers, it doesn't mean that the nth time that they try, this time with crypto-based system, that it won't work, right? There could be very significant areas of disruption, and they could come with great speed.
Yeah, I think that's such a unique way. And the piece that I'm still kind of thinking through as you're kind of talking to me is the point on the regulatory arbitrage in particular sounds particularly fascinating because it seems like right now too, with what we've seen in recent months with the Genius Act and so forth, even the kind of route and path to regulation is working out in a different way when it comes to this new novel assets and this asset class, right? And so it
Oh, yes.
requires a new fundamental way of thinking about the future.
Yeah, so that is one of the big things that's changed enormously in the last 8 months, particularly since Trump's election. MiCA, to give credit to the Europeans because they thoroughly deserve it, MiCA is an outstanding piece of legislation and paved the way for a lot of the content of the Genius Act. Americans tend to like poo-poo the Europeans, like, oh, America innovates and Europe regulates. Well, MiCA is a very good piece of regulation, and it leveled the playing field very nicely. The Genius Act goes even further, and I think both MiCA and the Genius Act really turned on their heads um, a big piece of conventional wisdom that people had before before the Trump administration. There was an assumption when you talk to bankers in the traditional finance industry that if we ever got to a world where there was a lot of kind of crypto rails and blockchain infrastructure, they would be a mixture of public and permission chains, that regulatory compliance tools would be deeply embedded into the system. So you would have, like, instead of just having the standard fully interoperable open ERC20 fungible money token, you would have this tightly controlled specialized token that's permissioned, it's access controlled, and all kinds of things like that. That assumption was wrong. Right. What we're seeing now is that the regulatory structure says you can go ahead and launch bearer assets using fully standard tokens on public blockchains that are completely open and interoperable. And the reason why this is a very, very big deal is that it means that the marketplace that we're going to have is going to be much more intensively competitive, right? Complex rules, deeply embedded integrations for regulatory compliance are also a really nice way of saying we're going to give you lots of places where you can protect your market position, you can minimize the sort of the hyper intensity of competition, you can put in some of the frictions that exist in the traditional banking world about moving accounts and banks. All of those things are gone, right? We are stepping towards an extraordinarily intensively competitive space where, at least at the moment, it's not really clear how you're going to defend some kind of existing market share, client relationships, etc.
And it seems to me like, a big part of, and you touched on it earlier on, right? A big part of the existing financial infrastructure felt like it was somewhat protected from the DeFi world because of, the kind of regulatory landscape that exists. And now it sounds like the Genius Act is saying, actually, these DeFi players can compete with these established financial institutions, at least in some domains, and domains in particular related to stablecoins and those payment instruments. How who is going to be in your perspective? Does this change the competitive dynamic between TradFi and DeFi players? Does this make DeFi players a lot more of a threat to TradFi players? And within the TradFi space too, are there already players that have done well out of this? I'm thinking of the likes of JPM, for instance, who've had their own blockchain for a long time, but now are also building up assets that they will have listed on Coinbase, for example, paving the way for tokenized deposits in the near future, for instance. How are you seeing this dynamic play out as a result of the Genius Act?
It's very interesting because it's fair to say the traditional finance players, quite a few of them have done a really terrific job of like stepping up and getting ready for this competitive battle. So kudos to JPMorgan. Like, they were a serious player from the get-go with crypto and blockchain. And it is so heartwarming to see them start putting stuff onto the public Ethereum mainnet and working with Coinbase. Like, that is something I've wanted to see for a long, long time. And it makes me really happy. And it makes me optimistic about the chances of traditional finance players. I gotta, give credit to Robinhood. I don't know if you would call them like a traditional financial player, but going ahead and launching an Ethereum L2 is very serious. PayPal, another good example. So we're seeing a lot of good signs of traditional financial players entering this market, and they have a lot of advantages, right? They understand the regulatory process much better than some of these new startups, and they've got the customer relationships. They have a much more complete, Citibank and Charles Schwab have a much more accurate and complete picture of my financial assets than Coinbase does, right? And so on the DeFi ecosystem, there's really good services for, say, borrowing against your existing assets, right? Sort of collateralized lending, but there's very little in the way, like, you can't do collateralized lending on chain against the value of your house, right? I can't get a home equity
Yes.
loan on chain yet. So, and the traditional banks like Wells Fargo have much more data about my mortgages and things like that. That being said, there is a big challenge, I think, which is, in general, in the world of business transformation, it's easier to add capability than subtract bureaucracy. And traditional financial players have a lot more overhead. They have a lot more cost structure. I took both of my sons to a big traditional bank over the weekend to open a bank account. And I'm not kidding you when I tell you that it took 2 hours. We sat in a bank office for 2 hours in order to open up 2 checking accounts for 2 teenagers under the age of 18, right? That is, you know, I don't assume that this bank is particularly more or less efficient than the others. I assume that is the cost of compliance and the cost of complexity in their organization and process. And when I think about stuff like that, I think that some of the traditional banks, they have all these assets, but they are going to have a really challenging work ahead of them to meet the competitive pricing that's probably coming for a lot of these things.
I love that line that, it's much easier to add capability than to reduce bureaucracy, because I think it really speaks to some of the kind of challenges that we see in the space, right? And it kind of touches on, I guess, a question that I'd been meaning to ask you, which is, you know, from an outside perspective, there is a degree of, I guess, a little bit of confusion as to why some of the big traditional financial institutions have taken so long to adopt some of the kind of real value, seemingly at least, real value adding benefits of DeFi. And so it sounds to me like much of the challenge is not technical. And is this something that, your experience also kind of validates? There is more of a cultural issue, particularly around, thinking about innovation, thinking about inventorying that innovation and being able to kind of, have a long view of what your business looks like over the coming horizon, and being able to take those hard kind of decisions that at times will seem like they might be cannibalizing or focusing on something that's much more future based than what you have currently. Is that validated from your experience?
Yeah, so I think there's two factors that make it hard for traditional finance firms to go as fast as they would like to go, or as they should go. The first is that this is so for a small crypto or blockchain startup, this is not a multivariable equation that you need to solve. It's very simple, right? If you think it's legal, you can do it, and if a regulator tells you no, and the no means you're going to go out of business, then you need to sue the regulator or find some other solution to make it work. So this is why you see a lot of the crypto pure plays and the blockchain natives. They're much more competitive with the regulators. They push the envelope much, much harder. Now, if you're a bank, if you're a traditional bank and you have many points of interaction with the regulators, and you have a legacy business to defend, then you are solving a multivariable equation, not a single variable equation. And that's much, much harder. And it's going to make you much more cautious because you have deep pockets and a large existing business to defend. So that's one very strategic decision-making factor, which is going to slow down the bigger players, right? But it was really interesting to observe that, there are still very sensible, incredibly successful people in the financial services industry who just don't think that this thing has staying power. And, they have weight in large complex decision making. Again, startups are a bunch of like-minded folks, kind of racing all in the same direction. That's not true when you think about a large organization. Lots of people have lots of different opinions.
I think that's such a fascinating point there too, right? Because I think there's a flip side of this conversation too, right? With the DeFi space, I'm thinking in particular, post the ETFs last year, another big moment in the sun felt like the Stripe acquisition of Bridge, right? Where we get big kind of, fintech, but in that traditional financial service space, makes the biggest acquisition private acquisition it's done, and it really felt like a kind of it kicked off the kind of gun for the race when it comes to the stablecoin piece. And it does seem to suggest that maybe the DeFi space, it needs to do a better job of telling the story for the traditional financial services world in terms of where these two can be complementary, not necessarily always adversarial. How much do you think do you agree or disagree with that point?
That's an interesting question, right? I think we are reaching the stage in this market where like blockchain infrastructure is making this transition from something that we really talk about to something that's just plumbing, right? It makes stuff work. It makes it work cheaper and faster. I mean, it was a really big splash at ECC earlier this year, a couple months ago, when Robinhood unveiled their L2. But in reality, the vast majority of Robinhood customers are never going to know that they're transacting on an Ethereum layer 2 network, right? And increasingly, customers are not going to realize that they're making payments of these blockchain networks or that they're using stablecoins. All they're going to know is that they sent money or they bought an asset and it's in their account. And that's kind of where it's headed. So does the industry need to articulate like its specific value proposition? I'm not really sure. I think we're becoming plumbing. We're going to be invisible, and that's actually going to be the key to our success.
I guess to push you a bit more on that, one of the things I'm wondering is we've seen once the legislation is coming, right? Like there seems to be a huge amount of pent up demand that's really being released now with the Genius Act, and we're seeing that the amount of really established players from JPM to Walmart that are working on their own stable coins or moving towards the reality of tokenized deposits and so forth suggests that actually the real kind of stakeholders that need to be convinced of and that matter seem to be those established players. So far, it feels like a lot of the DeFi world has been, telling the story of how DeFi is going to replace TradFi. But it seems to me now, actually, the real opportunity lies in combining these two, right? Being able to have a digital asset protocol that allows the TradFi world to come on chain and actually start taking advantage of some of the real unique value opportunities that exist. Is that something you concur with, or you still think the reality is a bit more of this adversarial tension is actually what gets us more progress?
There will be a combination of adversarial tension, and then also occasionally people will sort of there will be these breakthroughs, and we'll see which big companies, decide to take the first plunge into like accepting stablecoin payments or offering to pay all of their employees in stablecoins. One of the big issues is, if you want stablecoins to be used or DeFi services to be used, people need accounts in this space. They need accounts. They need to have money in their accounts. And so this question of how you get money into the account and how you get the on-ramp is going to be very important. And for that, one of two things have to happen. Either the TradFi world has to provide this on-ramp, or the traditional crypto world has to get all the necessary banking licenses and sign up all the customers. I think, this is where the TradFi world has a big advantage. They can be the on-ramp. And one of the strategies that I think might be successful in the future is this idea of being a portal. So, if you're a traditional bank, you have lots of customer relationships, you understand the regulatory environment, you have everybody's KYC data, right? And there's a million things that you can help your clients invest in on chain. If you become the portal into this on chain world and you help clients find good, safe opportunities that are not crazy risky and squeeze a little bit of extra return, then you can sell those out to your clients. I think that's a really potentially great opportunity. I think of it a little bit like the sort of being a search engine, right? You have this ability to sell advertising space. You have the ability to earn commission. I think that's one of the big opportunities that will come up. And one of the things that I think we will see in the near future, and I predicted this in the past and been wrong or way too early about it, is we will start to see traditional banks and service providers offer what I would call a curated window into the world of DeFi. They'll say, listen, we looked at the whole world of DeFi and there's lots of risky stuff out there, but we found these 4 like deposit opportunities that will give you an extra 1 or 2 percentage points of interest, right, over the current rate. And we think we can recommend them to you as relatively lower risk compared to some of the other options. So if you want a bit of extra return for a bit of extra risk, here's some good ones, and our fee is this. And that I think will be the beginning of potentially really kind of ramping on more and more people into this on-chain environment.
Yeah, and that sounds like, we kind of had seen some of these emerge in outside of the DeFi space as, big kind of financial players using their customers as a kind of distribution channel for added on products instead of having to build on themselves, right? Earlier on, I asked you, what are the biggest misconceptions in the TradFi space when it comes to DeFi? As you're kind of, what's the flip side of it? From the DeFi space, what are the biggest misconceptions you're seeing when it comes to understanding how the TradFi world works and why maybe, some of the integration and some of the kind of progress has not been at the pace at which, the DeFi world is moving at? Is there anything you're seeing that you think could make that a lot more seamless and, create a lot more of an opportunity for faster innovation and integration?
Yeah, so there's three things that your typical DeFi company doesn't understand as well as they need to be successful, right? And the first is regulatory compliance, right? DeFi companies have been slow to embrace regulatory compliance. They've been slow to do enough. They've been slow to accept that they need to play by the rules. We're slowly seeing, in the same way that banks are accepting that DeFi is real and it's going to be competitive, we're seeing this sea change in the world of DeFi where people are like, whoa, I've seen talks at conferences this year where senior people who used to be like, waving the pirate flag are telling their business partners, we are going to be fully compliant whether you like it or not. So that's the first one, which is we're seeing this big shift, and I think it's moving along nicely. Second is system integration. So the whole world of crypto and blockchain is used to being this independent island, separated from the rest of the universe, and people are starting to understand like the plumbing of the global financial system is immensely complex, right? It's banks, it's financial institutions, it's SWIFT, it's enterprise users, it's ERP systems, and they're suddenly starting to grasp the importance of being plugged into those systems. It's not enough that people have, crypto accounts. Enterprises need to plug these things into their business systems so that they can do things like payroll and supplier payments and vendor payments and contracting. So system integration, like the plumbing of the financial system, people are starting to take that quite seriously. Thirdly, privacy. This is another really big one that people were almost hostile to in the early days of crypto. They're like, why do we need privacy? Sunlight's the best disinfectant, right? Well, the answer is if you ever want to have any kind of business user or serious long-term portfolio investor like on your system, they're going to need privacy. And privacy is still very immature in the crypto ecosystem. It's a big priority from us from a technological standpoint. We've invested probably more money than anybody else in building privacy tech, and we're going to start to see our privacy tech rolled out with some of these ecosystems in the coming year. So I'm very excited about that. But privacy is an absolute essential requirement for business users. And without it, we're never going to get past a small number of like testing payments and things like that.
And I think that tracks with a lot of what we're seeing now too, right? With like the fact that the DeFi space is a lot more actively, canvassing for support from regulators and lawmakers. It signals this kind of maturity and more understanding of how the financial system works and why it's so complex. Um, I know we're coming up to time, so I'm gonna, re wrap up to my last set of questions. We've already touched on this. This year, I think in particular has been the year of stable coins, and increasingly it seems like tokenization is about to become another big area of innovation in this space. As you're seeing the world of DeFi kind of mature. Where is, how much of this conversation with respect to things like stable coins and tokenization is overhyped, and how much of it is yet to properly be investigated? Is there an area that you're thinking, wow, I'm surprised that there isn't much more attention being, placed on this? Or so far you think, is everything kind of tracking with your expectations too?
I wish everything was tracking with my expectations. We would be so much further along, and we would be doing so much more than just stablecoins, right? In some ways, I'm thrilled with how much progress stablecoins have made, but they are just a small piece of the equation, right? And this is where I think, if you want to talk about like where will we be in 3 to 5 years, where I hope we will be is that stablecoins will be everywhere, but that we will have expanded our thinking beyond stablecoins. Every single business agreement in the world really boils down to this very simple kind of set of principles. I have money, you have stuff, and we're going to exchange my money for your stuff under the terms of some kind of agreement. We can tokenize the money. We can tokenize the stuff. We can write the agreement as a smart contract, and we can bring all of those things on chain. And the reality is that the payment is actually the cheapest part of the whole process. Organizing the agreement, tokenizing the stuff, tracking it, managing the supply chain, all of those things cost more than the payment. So, however much money there is to be saved by improving the payments process, there's 50 times that amount to be saved and improved upon by bringing the entire business agreement on chain into a single infrastructure that reconciles automatically. And so we are at the beginning of a massive, massive kind of economic growth and opportunity cycle, which is really just getting started. Stable coins are the first essential ingredient, right? You can't have a business agreement unless you pay for something. But once we have the payments done, we have this huge opportunity to bring all the other pieces of the equation into the system and have them run inside the same infrastructure, which is not something that's happened in the past. Historically, money has had one system and stuff has had a separate system, and they've even on an information technology side, they don't meet very well. They meet sort of messy and manually inside of large company systems, and we can do so much better than that. And the opportunity to take that, just the money part, and turn it into a complete business agreement represents, my estimate, 50 to 100 times more than just the savings from improving payments.
I mean, that would be remarkable amount of transformation, right? 50 to 100 times. I know you almost preempted my last question, but I'm gonna, still ask it with a little tweak maybe. Talking of predictions, in 5 years, let's say we're having this conversation again, and we're talking about the intersection of DeFi and TradFi. Do you think those 5 years would have developed through, what we're seeing right now, this kind of process of incremental adoption? Or do you think in 5 years' time we'll have like a real fundamental redesigning and rethinking of what financial services would look like?
We're going to have a little bit of both. So if you think about how kind of big economies change, they change in many areas somewhat slowly. They kind of move along, and regulatory kind of changes take time to take effect. So there's going to be one phase of this process that moves in this like nice orderly pace. If you look at the history of e-commerce, really good example, it didn't blow up overnight. It's been growing about 20% a year every year for the last 20 years. And I think there are big parts of on-chain commerce, payments, et cetera, that are going to grow at 20% a year every year for the next like 20 years, because 20% a year seems to be how fast we can sort of drive change into traditional industries, right? Retail is a good example of a traditional industry with lots of physical infrastructure and people and organization and stores and customers with set habits. However, one thing that may be quite different in 5 years' time is that we could also have this exploding new segment, which might be as large as the traditional segments, which is agentic and autonomous commerce that's driven by AI, right? So AI agents are going to start doing a lot of transacting on behalf of their users, their customers, investors, and I think the combination of AI and blockchain is a really powerful combination. AI provides a sort of suggested activities, recommendations. Blockchains are a really powerful mechanism for execution at scale. And the two of them could come together. And it wouldn't surprise me if 5 years from now, transaction volume by autonomous systems is larger than transaction volume by kind of human-driven business processes.
So we're gonna make sure that we hold you to that, and in 5 years we'll do an inventory and see who's ahead. Paul, thank you so much for your time today. And as a by way of wrapping up, one last bit for you is, um, you work with TradFi and leaders in that space, and you're also working and you're deeply passionate about the world of DeFi. Speaking to both of them and our audience of senior leaders that work in this space, what's the one kind of message you want to leave them with as they're thinking about the world of financial services and the growing interconnectivity between these two seemingly parallel forces?
One of my big hopes is that as crypto and blockchain come into the mainstream, we will do a much better job of treating our customers right, that there will be less fraud, less crime, less rug pulls. And one of the things, if you look at the winners in the crypto space, they always invested heavily in regulatory compliance. And if you look at the winners in the TradFi space, they are really good and rigorous about regulatory compliance. And that is not something I want to see go away. I feel like one of my jokes is that, the blockchain and crypto industry is really good at providing ammunition to our critics. We are fantastic at that. And I would like us to be less good at that one particular thing. And it is my hope that as the industry matures, we will in fact become less good at that.
I love that. I think that's a great way to put it. Paul, thank you so much for your time. It's been such a insightful conversation, and I know our audience will enjoy it too. And hopefully we'll be able to carry on this conversation with you or with your colleagues from EOI in Vegas very soon. Thank you.
Thanks very much.